Hey everybody, I hope you're doing well. I took the excerpt from the Wednesday market commentary and have made it into its own video. Had a couple people reach out to me asking if I could do that as I clarify the risk entry and the confirmation entry and the two entries within those price action models, just so that they're a little bit clearer. So I hope that this video is a great reference to understand the risk entry and to understand the confirmation entry and the process between the two. So let's jump into it. One thing I wanted to talk about, probably should have mentioned it in Aussie dollar, but it's really just on the entry models that I dropped, and really just, again, to say the point, I'm not very good at names and it's kind of coming to that. So just wanted to quickly talk about the entry model. So say we have we'll call this a 4-hour point of interest, and we're waiting for price to come into that, and it does whatever it's doing and it's starting to come up to it. If we are putting on a limit order on that 4-hour block with a stop loss around that 4-hour block and looking to trade that entry, this would be a pure risk entry. It's more of that set and forget style. We could refine this down to the 1 minute if we wanted to, but again, all we're really looking for is price to create a point of interest, come back, we set our limit order, and then price tags us in and continues or stops us out or whatever it does. But if we want to look at a confirmation entry, we'd have our 4-hour point of interest, and we'd be waiting for price to come back to it. And as soon as it taps into that, we would drop down to our execution time frame, whether it's a 15-minute, a 5-minute, a 1 minute, or anything like that. And we're waiting for price to tap into that and then break structure to the downside, which is in line with our bearish order block, our 4-hour point of interest. And basically we're presented with two entry opportunities. We'll use just a slightly different color just because I make it a little bit easier. So we'd have our first point of interest because we've broken this bit of structure here. So we could look to take that entry. That would be entry number 1, as I was calling it a risk entry, but I think that there was a little bit of confusion in the risk entry, taking it on the 4-hour point of interest with the limit order and not using lower time frame, waiting for that break of structure and continuing. So we'll call it entry 1 for all intensive purposes right now. And then we have our secondary entry, which this one is a little bit less confusing. It's a double confirmation entry. We break structure for a second time and we can look to enter there. And basically, again, what that means, that double confirmation entry, is when we break structure to the upside and then break it to the downside. Initially, what we're looking at is that we've swept liquidity and we're looking to take that short, and that's our confirmation. But what's to say that price doesn't just do this? And basically what it ends up being is we take the liquidity on the downside, come to the upside, and break that structure and then continue back to the upside. Whereas if we're looking for that double confirmation entry, so we see that tap in and continue, we break structure. So we've broken structure twice and then we come up and then continue. This would be the much safer entry versus this one, because this entry number 1 doesn't actually confirm that the structure has changed, that there has been a change of character, anything like that. So when we look for entry number 2, that's the best way to position yourself. Now, one thing that you may also notice from time to time when you get these sort of entries is we get that break of structure. We don't actually tap into this area. We create something like that. We tap into that, continue. We almost print equal highs, but we haven't actually mitigated the first part. So in that event, we get something like this, and we tap into that. There's nothing wrong with taking this entry right here. So this one right here, because we broke structure here. That's straight. So our initial break of structure was here. We created this point of interest, but we didn't tap into it. We created this lower high, and then we broke structure. We've come in, we've tapped into that, mitigated that order block that was created from this reaction, and then continued. In this case, this would almost be our entry number 1, and then this would be our entry number 2. And the reason that this entry would still be viable and valid was because we have the liquidity that's resting above these two equal highs. More often than not, we have the imbalance as well. And similar to many other cases as well, we might even have, just draw this backwards, but something like that where we have equal highs that get taken out, creates liquidity, comes to the downside, breaks structure. So we're starting to shift bearish. We get another break of structure, shifts bearish. We tap into a point of interest, and we come to the downside, we may have moved to break even, and then you see price run all the way back up, tap that initial point of interest, and then that's where the real entry comes. So I just wanted to address that a little bit. Naming not so great in terms of a little bit of confusion. So if you're looking at a pure risk entry, it's basically setting that limit order on a higher time frame point of interest and not waiting for any sort of break of structure or anything like that. Once you get that order block, you set your order and you just go with it. Really great for a set and forget style of trading and sort of approaching it that way. Whereas a confirmation entry is you start with a higher time frame order block, and then you're waiting for price to come into that order block. Then you're waiting for price to switch trend and break structure in line with that order block, and then entering on the fractal order block within that higher time frame point of interest. And you have the first entry, which I have been calling the risk entry, but I think naming it something else might be a little bit better so it's not as confusing. And then we have entry number 2, which is the double confirmation entry. Again, it's a double confirmation entry because we've broken structure twice, and it's given us more confirmation that price is willing to and has intent to continue that trend. And then we have a little bit of an extra variation that we can just briefly talk about. There was basically, where we get that entry number 1, which in looking at the initial model, this would almost be the double confirmation entry because we've broken structure twice. But in this case, we've left an unmitigated point of interest, we've left imbalance, and then we come back up, tap into that. That would be our double confirmation entry. So it's set up slightly differently, but it's more of a play on liquidity. So I hope that helps. I hope that keeps you a little bit more, or gives you a little bit more clarity on these entry models. And if you have any better names for this first entry, this entry, please let me know. Again, I said I'm not very creative when it comes to names, and I was not lying about that. So if you do have a better name for what is currently known as this risk entry, part of the confirmation entry, let me know, and we will definitely just change it so that it's less confusing and more straightforward. But that's the delineation or the difference between a conventional pure risk entry and then looking at the confirmation entry and the 2 entry types within those confirmation entries. So I hope that was helpful. And just adding on really quickly to the whole risk entry versus confirmation entry, this is probably a little bit cleaner way of explaining it. You have your 4-hour order block. If you just set a limit order on that order block, whether you refined it down to a 1 minute or 5 minute, and you're not looking for that break of structure, that would be a risk entry. Whereas if price comes into that 4-hour order block, taps into it, you drop down to your execution time frame, and you start to see that break of structure. The first one would be that entry 1, and that second one would be entry 2. And the second entry is safer because you have that additional break of structure, whereas the first entry is riskier because the trend hasn't fully changed or confirmed, because it could be a grab of liquidity. I just wanted to show this as well because I feel like this diagram that I created for someone else this morning might actually be helpful in articulating what I was explaining just earlier.